Politics and economic blunders have taken full control of our investments. Predicting the short-term fluctuations of the stock market during an election year while multiple wars are being fought is like flipping a coin. But we've gone into the future and have come back with this message. More money will be printed, borrowed, taxed, or inflated, and the price of commodities and metals will climb. When you have multiple wars going on and leaders spending their way into leadership, it's inevitable. This is why mining stocks might finally make a comeback. When this happens, you better know what to look for. A few weeks ago, we wrote a piece on the basics of mining valuations titled Mining 101. This week, we'll go more in depth on this subject as part of a mini series of letters that will focus on evaluating mining and resource stocks. This week's topic will be cutoff grade, a term you have heard many times before, but is often overlooked or misrepresented. Yet, it is an extremely important factor in valuing mining stocks. Cutoff grade theory and practice. Consider a block of ore that weighs 1 ton and contains 3 grams of gold. At a gold price of US $2,000 per ounce, the value of the gold in the block of ore is just under $194. Simply put, if it were to cost more than $194 to mine, treat, and extract the gold from that ton of ore, it wouldn't make sense to mine it. On the other hand, if the cost were less than $194, it might make sense to mine it. It's a simple concept, but it's not that simple. Here's why. If all the tons of ore in a deposit contained the exact same grade of gold, it would be easy to calculate. But not all the tons of ore that make an ore body contain the same grade of gold. As a matter of fact, gold deposits may vary the most in terms of consistency due to its nuggety nature. Take a look at this chart. As you can see in figure 1, in this particular ore body, roughly 30% of the total tonnage has an average grade of 3 grams per ton, 20% has 2.5 grams per ton, and so on. Making the initial estimate. Let's assume that a preliminary feasibility study provides the costs for recovering gold, getting the gold out of the rock, with these numbers. Metallurgical tests also show that only 95% of the gold can be recovered from the ore. So the question is, what is the minimum amount of gold the project needs in 1 ton of ore to make it economically recoverable? As the table shows, there has to be enough gold to provide US $46 of revenue to cover the costs. In other words, the grade that provides the US $46 is the cutoff grade. To keep it simple, let's now assume that the gold price is $1,000 per ounce, which is equal to $32 per gram. The formula is simple. Total cost divided by recovery divided by price per unit of metal equals cutoff grade. Therefore, in our example, 46 divided by 0.95 divided by 32 equals 1.5 grams per ton. Now, if we go back to the original tonnage grade distribution as shown in our graph, we can see that roughly 6% of our ore body has a grade of less than 1.5 grams per ton. Obviously, when we mine the ore body, we would try and stay away from mining and certainly would not treat the 6% of tonnage below the cutoff grade. That means for reserve reporting purposes, we have reduced the size of our economic ore down to 94% of our original tonnage, while we have reduced the tonnage above the cutoff by removing the uneconomical 6% of ore. The remaining average grade will have increased as the lower grade is no longer included. That means that increasing the cutoff grade reduces economic tonnage, but increases the overall grade. Now, here's where it gets complicated in assessing the NPV, or net present value, of a project. A whole textbook can be dedicated to cutoff grade and assessing the NPV, but we will simplify as much as possible for all intents and purposes. How to calculate mining NPV. First, we determine the mine life. Let's assume that the annual treatment capacity can process 10% of the original total reserve. With a 0 cutoff grade, the original mine life would be 10 years. If you increase the cutoff grade, you decrease the life of the mine due to diminishing reserves. Reserves are ore in a deposit that is economical to extract, but you would increase gold production due to the higher grade. Now, if we assume that capital cost is relatively fixed, it is possible to estimate the NPV for each cutoff grade because we know the operating cost, the mine life, the gold price, and therefore revenue. Looking at the table, you can see that as the cutoff grade increases, so does the NPV. This is due to the greater benefit of a higher annual cash flow from the higher annual average grade outweighing the shorter mine life. However, eventually, the shorter mine life becomes too significant and the NPV declines. Looking at the table, you can clearly see that a cutoff grade of 4 grams per ton reduces the relative NPV down to 0.6. Again, remember, that increasing cutoff grade reduces your mine life as you throw away the lower grade ore in your calculations. That means that the higher the cutoff grade, there's even a possibility that the NPV would be negative as the mine life and recoverable ore becomes too small. The important factor is selecting the cutoff grade that yields the highest NPV. In our table, that means selecting the 2.5 grams per ton cutoff grade. Of course, this is an extremely simplified example using an extremely simplified calculation of NPV we used previously. With the advent of new technology and computing software, the optimum economic recovery of an ore deposit can be fine-tuned even further, especially with additional data, drill results. That means it is quite possible that the optimum cutoff grade in our example is somewhere between 2 and 2.5 grams per ton before the NPV drops. In our example, the higher NPV was achieved using a higher cutoff grade as a result of increased annual revenue outweighing the shorter mine life. However, cutoff grade will vary significantly from one project to another as many factors such as mine capacity, mill capacity, and commodity prices can all affect the NPV. The next time you hear about a project that is comparable to another successful mine, remember that no deposits are ever the same. A minor gram per ton variation in cutoff grade can have significant effects on a project's NPV, and calculations in NPV can vary dramatically from one source to another. That's why larger projects often have to go through numerous calculations from different sources before proceeding. When calculating NPV, there are obviously conflicting factors. For example, your capital costs will increase when you increase production, but you need to keep it to a minimum for a given production rate. An increase in annual mine production will generate higher revenue, but it's subject to available reserves and must be enough to satisfy the capital expenditures. The list of conflicting factors go on, so it's imperative that calculations are correct to optimize the NPV of a project. There you have it, the basics of cutoff grade.